Morgan, it's a miss on the top and the bottom line for Tesla. We're going to start crunching the numbers within the numbers, but let me give you the top and the bottom line. First of all, bottom line, they earned 45 cents a share in the first quarter. The street was expecting 51 cents a share, so a miss by 6 cents a share. Revenue coming in at $21.03 billion, light of estimates, which were at $22.15 billion. So, and the top and the bottom line, you've got a miss there. And then one other note regarding guidance on deliveries for 2024. We were looking for a number. We have not come across one yet, except for language similar to what we heard in the fourth quarter, that they expect notably lower deliveries this year, 2024, compared to 2023. What does that mean in terms of the specifics? Haven't come across that yet, guys. But again, you have a miss on the top and the bottom line for Tesla. We're going to dive into the numbers, look at things like automotive gross margins, excluding credits, et cetera, and we'll have that for you in just a bit.
So I hate to ask a question, Phil, that has no answer that a reporter can give. But have you seen anything in this report yet that would explain why the stock spiked up almost, 8% initially? Now it's down around 3%. Maybe it's just algorithms out there or some initial anything?
Not yet. Not yet, John. Have not come across something. And there may be something within these numbers that when you start crunching them and going through it and you say, okay, not as bad as we were expecting. Or when you look at the energy storage business, maybe there's some indication of some news in there that will give people some optimism here. But nothing at this point that you can hang your hat on and say, well, that's exactly why the stock has moved higher.
Okay. Well, we know we got 31 pages in this report to go through. So, Phil, we'll let you get back to it. In the meantime, just taking a look, even at page 1 here, John, I mean, they're talking about increased AI training compute by more than 130% in Q1, record energy storage deployment, produced over 1,000 Cybertrucks. We don't really talk very much about Cybertrucks in a single week in April, and talking again about the fact that the future is not only electric, but quote unquote also autonomous, perhaps teasing ahead to that robotaxi announcement we get in August.
Yeah.
I know. You're very skeptical about this.
I'm just saying be careful out there. It's a stock that's being watched very closely. It was initially up like 8, then it was just down around 2.5 a bit. Now it's up at 4. It's going to be a long afternoon for those trading tests. Yeah.
Give me an idea of what your psyche is like here going into this report, given the history and the most recent declines in shares.
Well, I mean, I think this is going to be this is the most anticipated earnings call in as long as I can remember. So just this time last year, they did 85 cents for this quarter. The street estimates are at 50 cents. So this is not good. They need to come out, or Elon needs to come out, I think, and take a page out of Mark Zuckerberg and stop talking about robotaxis like he was talking about the metaverse. Obviously, they're doing layoffs, which is smart. They got to get fit. But I think that they need to come out with a plan of, we need to get EV sales in line, full self-driving subscription. Let's hear about that. Let's hear about Optimus. Let's hear about all the other things they're doing. Let's not talk about robotaxis. I think if that is part of the narrative, that's part of the narrative today, the stock's going to go lower. I don't think it will be. I think Elon, he didn't go to India. I think he's going to take this seriously. And I think I wouldn't want to be short going into this call just because there's so much bad news already priced in, Scott.
Even if he takes it, in your words, seriously, how do you deal with or reconcile continued price cuts when the street thinks they're done, losing market share in China? You mentioned getting leaner. The whole maybe strategy shift, if you will, this robo-taxi idea, which you don't want to hear anything more about, but you might. And I'm curious what happens if you do. And then just a general EV slowdown. So maybe the goalposts have just moved in a way that you and other bullish shareholders didn't expect them to.
Sure. I mean, the EV slowdown in the U.S., as I've talked about a bunch, are not a big, it's important for like the story, but really it's China. And I still think that's the biggest risk in the name. I mean, as I've told you before, when I originally bought it, I sold calls against it, and which is I like to do, which is a good thing to do, I think, in these types of names. But to me with China, I mean, the Model 3, first of all, Scott, is the #1 selling EV car in the world. And China's growth is still growing. If they can continue to be with BYD, China's a very big market, but they have to have a good plan there. And so to me, that's my concern on the name longer and midterm is what happens in China. I'm less concerned with the US because it's really not that big of an EV market to begin with.
But isn't the writing kind of on the wall, so to speak, in China? If they're already losing market share, the price cuts don't seem to be making much of a dent. And do you have confidence that things are really going to improve there?
Well, I mean, I'm cautiously optimistic. You can lose market share as long as the buyer share is growing, right? So, I mean, you can be a smaller piece of a bigger pie. And so, I mean, China's all in on that. I also think it's only 6% of revenues, but year over year it grew at 50%. Energy storage longer term, it's not going to do anything for the stock today or tomorrow, but that continues to be a narrative underneath, kind of like Apple in the early days. So let me just be clear. I think it's dicey. I've said this before, murky over the next few quarters. Half my position got called away because I do sell calls. But I think that longer term, I'm still want to be in this name, unless he goes all in on the robotaxi. If that's part of the narrative, I'm out. That's to me like flying cars. It's just not pragmatic. And so, as I said in the beginning, I want him to channel that Mark Zuckerberg. What he did, that really good pivot at Facebook or Meta, to say we're not going to spend so much. It's easier in an asset-light company, but I think it's going to be a must-listen-to call, that's for sure.
Wow, I mean, you sound, to borrow an expression from our friend Sebastian Page, like a reluctant bull, almost looking for reasons to get out rather than to stay in. But let me ask you this. Yeah. Given everything you said, and what stuck with me especially is the China story, where you talked about having a smaller piece of a bigger pie. If that, in fact, is the case, then why does Tesla deserve as much of a premium valuation that it was getting before if the story in one of the biggest growth markets on Earth isn't what it was?
Well, no, I mean, if you're a smaller piece of a bigger pie, you can have more of a story. I think that, I mean, I've looked at the Chinese market and looked what he's done there. And to me, like on the bearish side, they've literally copied him. Some of these cards have like the black credit card key exactly. So, I mean, that's a real pragmatic narrative that I have to think through. But I still think that's the growth engine for Tesla. The cars is in China. And we're just going to have to get through the next 2 quarters. And like, listen, I'm a pragmatic investor. And that's where if he would to go full robo-taxi, that's just not realistic, right? So that's not realistic. The market wouldn't like that. And so I would reevaluate there. But I just try to come in and be pragmatic, not dogmatic either way, and just take from the market what it gives me. But I am excited to listen to the call. And I think everybody else is as well. I think the expectations are incredibly low, Scott.
Yeah, we'll see what happens.
Tesla's first quarterly earnings report of 2024 has dropped, and the stock market is in a frenzy. The electric vehicle giant missed analysts' estimates, sending shockwaves through the investing world. But amidst the disappointing figures, there's a hidden gem that has investors buzzing. Could this be a clue to Tesla's secret growth strategy? Welcome back to InvestMinder, the channel that keeps you ahead of the curve in the ever-evolving world of investing. Don't forget to subscribe and hit the bell icon to stay up to date with our latest insights and analyses. Disclaimer: we are not a professional financial advisory firm, and this content is intended for educational and entertainment purposes only. Please consult with a qualified professional before making any investment decisions. Now let's dive into the juicy details of Tesla's Q1 earnings report and uncover what's really driving the stock's volatile movements. Tesla's Q1 2024 earnings report has left investors scratching their heads, with the company missing Wall Street's expectations on both earnings per share and revenue. The electric vehicle pioneer reported earnings of $45 per share, a significant shortfall from the analysts' consensus estimate of $51 per share. Similarly, Tesla's revenue for the quarter came in at $21.03 billion, falling short of the projected $22.15 billion. While these numbers might seem disappointing at first glance, it's important to remember that Tesla is not just a traditional automaker. The company's visionary CEO, Elon Musk, has repeatedly emphasized that Tesla's future lies not only in electric vehicles, but also in autonomous driving and energy storage solutions. In fact, the earnings report highlighted some impressive achievements in these areas. Tesla boasted a staggering 130% increase in AI training compute for the quarter, a clear indication of the company's relentless pursuit of self-driving technology. Additionally, the report mentioned a record deployment of energy storage solutions, solidifying Tesla's position as a leader in sustainable energy. But perhaps the most intriguing tidbit from the report was the mention of the Cybertruck. While details were scarce, the report stated that Tesla produced over 1,000 units of its highly anticipated electric pickup truck in Q1. This revelation has fueled speculation that the Cybertruck's production ramp-up might be closer than initially anticipated, potentially offering Tesla a competitive edge in the lucrative truck market. Amidst the mixed bag of earnings data, one thing is clear: Tesla is not resting on its laurels. The company's unwavering commitment to innovation and its diversification into adjacent markets like autonomous driving and energy storage could very well be the key to its long-term success. As investors grapple with the implications of Tesla's Q1 performance, it's essential to look beyond the headline numbers and consider the bigger picture. While the market's initial reaction might have been one of disappointment, the underlying strengths and strategic positioning of the company could ultimately prove to be more consequential. Tesla's ability to navigate the rapidly evolving landscape of electric vehicles, autonomous driving, and sustainable energy solutions will undoubtedly shape its future trajectory. And for investors willing to embrace the company's unconventional approach and forward-thinking mindset, the rewards could be substantial. While Tesla's Q1 earnings report may have left some investors feeling uneasy, it's important to remember that the company has consistently defied conventional wisdom and charted its own course. Elon Musk's unwavering vision and audacious goals have often been met with skepticism, but time and time again, Tesla has proven the naysayers wrong. One aspect of the earnings report that has garnered significant attention is the company's guidance on deliveries for 2024. While specific numbers have yet to be provided, Tesla has hinted that deliveries this year are expected to be notably lower compared to 2023. This cautious outlook has undoubtedly contributed to the stock's volatile performance in the aftermath of the earnings release. However, it's worth noting that Tesla's delivery numbers have historically been a source of contention, with the company often exceeding its own projections. Musk has repeatedly demonstrated a willingness to underpromise and overdeliver, setting conservative targets and then surpassing them through sheer force of innovation and execution. Furthermore, Tesla's long-term prospects extend far beyond the realm of vehicle deliveries. The company's continued investment in research and development, particularly in the areas of artificial intelligence and autonomous driving technologies, could very well reshape the entire transportation industry. Tesla's relentless pursuit of self-driving capabilities has been a consistent theme in its strategic roadmap, and the earnings report's mention of a significant increase in AI training compute signals the company's unwavering commitment to this goal. As autonomous driving technology matures and gains wider acceptance, Tesla's early mover advantage in this space could prove invaluable. Moreover, the company's foray into energy storage solutions, as highlighted by the record deployments in Q1, underscores its broader vision of a sustainable energy future. Tesla's expertise in battery technology and energy management systems positions it as a key player in the rapidly growing renewable energy sector, opening up new revenue streams and diversifying its business model. While short-term fluctuations in stock price and quarterly earnings may dominate the headlines, it's crucial to maintain a long-term perspective when evaluating Tesla's prospects. The company's ability to disrupt multiple industries simultaneously, coupled with its unwavering commitment to innovation, could very well pave the way for unprecedented growth and success in the years to come. Amid the flurry of reactions and analyses surrounding Tesla's Q1 earnings report, one aspect that deserves further exploration is the company's potential strategic shift. While Elon Musk's ambitious goals and unconventional approach have often raised eyebrows, his ability to pivot and adapt has been a hallmark of Tesla's success. One area where this adaptability could come into play is the company's pricing strategy. Tesla's recent price cuts, particularly in the Chinese market, have been a subject of intense scrutiny. While some analysts view these moves as a desperate attempt to boost sales in the face of mounting competition, others perceive them as a calculated gambit to gain market share and establish dominance in the long run. Musk's boldness in implementing such aggressive pricing strategies should not be underestimated. Tesla has consistently bucked industry norms, eschewing traditional dealership models and embracing direct-to-consumer sales. This willingness to challenge established practices has often paid dividends, allowing the company to forge its own path and disrupt entrenched players. Moreover, Tesla's vertically integrated business model affords it a level of flexibility and control over its operations that few competitors can match. By owning the entire supply chain, from battery production to software development, Tesla can optimize its processes and adapt more nimbly to changing market conditions. This agility could prove invaluable as the electric vehicle landscape continues to evolve. While legacy automakers grapple with the challenges of transitioning to electrification, Tesla's singular focus and streamlined operations position it to capitalize on emerging opportunities more swiftly. Furthermore, Tesla's emphasis on software and over-the-air updates has transformed its vehicles into rolling computers, capable of receiving continuous improvements and new features. This approach not only enhances the ownership experience, but also positions the company to monetize its software expertise through subscription-based services and data-driven revenue streams. As the world increasingly embraces sustainability and seeks innovative solutions to combat climate change, Tesla's unwavering commitment to electric mobility could prove to be a significant competitive advantage. The company's relentless pursuit of cutting-edge technologies, coupled with its willingness to disrupt traditional business models, has the potential to reshape the automotive industry and redefine the very concept of transportation. As we wrap up our analysis of Tesla's Q1 2024 earnings report, one thing becomes abundantly clear. This company is not content with merely disrupting the automotive industry. It aims to redefine the very boundaries of what's possible in transportation, energy, and technology. Elon Musk's unconventional leadership and audacious vision have repeatedly defied conventional wisdom, and the latest earnings release is no exception. While the headline figures may have disappointed some, the underlying currents of innovation and strategic positioning paint a far more compelling picture. Tesla's unwavering commitment to pushing the boundaries of artificial intelligence, autonomous driving, and sustainable energy solutions underscores its broader ambitions. The company's vertically integrated business model, coupled with its agility and willingness to challenge industry norms, positions it to capitalize on emerging opportunities that traditional automakers may struggle to grasp. Moreover, Tesla's emphasis on software and over-the-air updates has transformed its vehicles into dynamic platforms, capable of evolving and adapting to the ever-changing technological landscape. This approach not only enhances the ownership experience, but also opens up new revenue streams and monetization opportunities that could propel the company's growth to unprecedented heights. As the world grapples with the urgent need for sustainable solutions and innovative approaches to transportation, Tesla's unwavering commitment to electric mobility and renewable energy could prove to be a significant competitive advantage. Undeterred by skepticism and undaunted by challenges, the company continues to forge ahead, disrupting industries and redefining the very concept of what's possible. Whether you're a seasoned investor or a curious observer, Tesla's Q1 2024 earnings report serves as a reminder that true innovation often defies conventional metrics and requires a willingness to embrace the unconventional. As we bid farewell, remember to subscribe to InvestMinder for more insightful analyses and thought-provoking discussions on the ever-evolving world of investing.
Thanks again for watching, and good luck with your dividend empire aspirations. Hope you found today's analysis helpful as you look for profitable new stock opportunities. This was InvestMinder. Remember, knowledge equals profit in the stock market. Thanks so much for watching, and please hit that thumbs up button if you got value from this video. Make sure you click to subscribe as well to get our next videos when we reveal the best new insider stock purchases. Invest wisely, trade carefully, and we'll see you next time. Disclaimer: InvestMinder is an independent stock market commentary channel for entertainment and basic informational purposes only. We are not licensed financial professionals and do not provide personalized investing or financial advice. P.S. If you stayed watching until here, you are awesome. Thank you for enabling me to keep making these videos with all the likes and subscribes. Have a great day, and we love you all.